Hello and welcome to the latest edition of the Tax Hour. My name is Nick Wright, Director and Head of Corporate Tax at Jones Miller, and I'm really pleased to be joined today by Douglas Roberts, Partner at TLT LLP. It's EO Day, we're talking employee ownership, of course, and this is the second employee ownership podcast we've done. We did one on EO Day last year. It was more about the transition into employee ownership trust, the model itself. So if you want to know all about that side of things, please go back and watch that. Today, Douglas and I are going to talk more about what we see in practice in terms of the actual sales into an EOT, the issues we've seen, the new legislation that's coming out. So we'll dive a bit more into the tax and the legal aspects of things, because that is absolutely crucial, and making sure this is done right is imperative given the tax at stake. So as I say, really pleased to be joined by Douglas today, and we'll get straight into it. Yeah. So for those who haven't done much on employee ownership before, let's just talk briefly about what it is, where it came about. And I find myself reading the same spiel, so maybe it'd be good actually if you bring some in as well. But so employee ownership, we've had it for 11 years now. Well, we haven't had employee ownership. We've had employee ownership for much longer than that. Yes. We've had an EOT, or we've had the legislation for 11 years. It was Finance Act 2014. It came about from Graham Nuttall doing a review for the then coalition government, and basically said employee ownership is a great thing for the economy, and we should really support this. So employee ownership then became, okay, well, how are we going to convince people to sell into an EOT? Why can't they just sell to their management team? Why don't they sell to a third party? And so let's give them a nice tax relief and pay no CGT when you sell. As of now, the EOA is reporting 2,250 employee-owned businesses on their website. But Douglas, you were at an EOA event, weren't you, yesterday?
Yes, yesterday, and Ollie Smith from the EOA said that it's up to 2,300, right. And they're expecting a few more. They expect to be at least 2,500 by the EOA conference in November. So
okay, so it's growing fast.
Yeah,
in the initial few years, it was very slow, wasn't it? Like yes. We're talking double figures per year max, and I think the last few years have been more like 500 a year, kind of. I don't know, that's very broad, but so yeah, I think the good thing about the industry and the fact that if employee ownership does benefit the economy, the fact that it's becoming more well known, more advisors understand it, I think is key.
Yes,
we've talked about there's more advisors in the sector, but making sure those advisors actually and understand the technicalities and the intricacies, because there are some quite important things.
So yeah, we are starting to see it become much more mainstream. In fact, I got a call a few months ago by someone I know at a bank, and they said they've had 4 conversations with clients recently, and in all 4, the client mentioned the option of an EOT.
That's interesting.
Never had that before.
Yeah.
So that's really there. The bank were saying, so they phoned me up and said, we need to find out more about these EOT things, because clients are coming to us and saying, we're thinking of passing on to the family, we're thinking of sale to the management team, or do we do an exit to trade? What is the EOT thing? And would you fund it? And that's one of the things for the banks as well.
Yeah, so, and we'll definitely come on to bank funding, because that's an important part, isn't it? I also think as a tax advisor, I think, and do correct me if I'm wrong here, but I think we as tax advisors probably have the conversation most of the time before maybe a legal advisor is starting to get involved in the process, or certainly an accountant, because they're coming to their accountant, who does the annual returns and things. I almost think it's negligent not to include employee ownership in a succession planning discussion.
Yes.
It's not right for every business. That's absolutely correct to say. But if a client says, "Oh, I've got a great management team, I want to sell to them," and you just say, "Okay, great, well let's go ahead with that." And then 2 years later, they go, hang on a second, that management team is pretty much the same as the entire employee group. I could have done an EOT and saved myself 24% in tax. So, it could have had the same effect for the business, but, save a huge amount of tax. So it's important that we, as advisors, accountants, tax advisors, lawyers, actually understand that this is available.
Absolutely, yes. It is just one of the options on the table, actually. And it's really interesting because some clients come to us and they've basically got to the situation where they want to pass it on to the management team, but the company's just worth so much because values are high. They're just saying realistically, the management team can't afford, and they might not get fund. They won't get funding for it.
Yeah,
and they don't have all this money behind them. So they're saying, I really want to pass it on to the management team. These guys have been with me for years, and I owe them because they've helped make me very wealthy. But I can't. They can't afford to do it. And you say, okay, yeah, obviously you've got Vimbos and things like that. But actually, if you thought of this EOT, the management team won't own the company at the end of the transaction, but you know what? They'll still be running it. And in a sense, they replace you, they become the boss. And as you know, you can put EMI options and things like that. There are ways of getting sort of skin in the game to those key individuals. So they're incentivized, so they are driving the business. Because as we know, all businesses need some people to be the drivers.
Yeah. And I think that's, I think it's, there's both sides of the fence. So you were just talking about whether the management team can afford it, but there's sometimes you have managers who don't want to take that risk. They don't want the direct share ownership because they're just quite very risk averse individuals. And, so we've had conversations both sides really, and how employee ownership actually can resolve that. But as you say, being able to do a combination of two, actually say we'll give some shares to the management team or share options and sell the controlling stake to the employees as a whole. Actually, it's a conversation I have on every employee ownership conversation I have.
We found some clients, it's a relief to them. They say, what? So there's a way that I can sell it to the management team. It's okay, it's not to the management team, it's to a trust, but it's for all the employees. And you've heard it hundreds of times. People say, I'm only where I am today because of my hardworking staff. I've got people who have been here for 20 years and I don't want them to lose their jobs. This business is important to the local community. And if I sell it to someone else, I'll just shut it down and move. Coming from Scotland, that's quite a big thing that a lot of Scottish businesses, they are bought by businesses and elsewhere in the world, whether it be England, America, you name it, they're bought. And then clearly decision-making moves out. Yeah. And they can say, why have we got a plant in Scotland when we can move everything down south or abroad? So, it's really important that people say, I've heard it so many times, we as a family haven't spent 50 years building this company just to put all of these local people on the dole. And so we line our pockets. And this is a solution they think, wow, this is brilliant. And it just ticks lots of boxes for them. And some people are already along the journey. Some people already speak to their staff. They already have bonuses and things like that. And so we say to them, you're part way along the journey to employee ownership. You've just not got it legally. This is a structure. Some people are really relieved and they say, this is a great solution, which means that, the hardworking management team, they can, in a sense, take over, but they don't have to give personal guarantees and things like that, which they just don't want to do.
Yeah. And it is interesting that what you said earlier about the fact that employee more clients are becoming aware before they've even had the conversation with a professional advisor.
Yes.
But I think, we mentioned the EOA, which we haven't actually explained who they are, but they're Employee Ownership Association. I'd probably say they're the main think tank. Is that the best way to describe them? They've got fantastic resources on their website, so it is worth going to check them out, even though we're in no way affiliated with them. I don't think we're just saying that they're a useful resource.
We are members.
Well,
they're very good, and they put on some really good events online and in person, and really just support it. They engage with HMRC, so they're there as the sort of umbrella body. Is that what to say? That look after and really encourage employee ownership.
Yeah. Okay, so we've talked a little bit about kind of the background. Where should we go next? Should we talk a bit about the tax? And I'm wondering how much to go into in terms of the original. So back in on the autumn budget 2024, we had a whole new set of criteria, and I think that's really what I want to focus on. So let's briefly cover the original criteria, which came out in 2014. And nothing has changed in employee ownership since 2014 up until the date of the budget. So that's quite a long time to introduce new legislation and then not touch it. It's over 10 years. So originally it had to be a trading company.
Yes.
And we've seen, it's the same test as other tax reliefs, business asset disposal relief, which was entrepreneurs relief, substantial shareholdings exemption. So a lot of people will be familiar with the trading requirement. We've already alluded to the all-employee benefit requirement. Yep. So all employees have to be entitled to benefit. And again, there's a lot more to it than that, but not that we can explain within the course of an hour on a podcast. The limited participator fraction, which I always sum up as basically saying you need enough employees.
Yes.
So the limited participator fraction basically says if you were already a shareholder, and there's an exclusion for people who had tiny percentages, less than 5%, but if you're already a shareholder in the company, you are in the fraction, which is 2/5, you're on the numerator, divided by the number of employees, the total number of employees. So if you are a shareholder, an employee or director, divided by the number of employees, that you need to have enough employees to satisfy that fraction. We have had some close to the mark.
Yes.
And in fact, we've had some that are below the mark and just don't qualify.
Yes. You have to wait.
Yeah. So you've got this 40% threshold. And there's a lot of employee-owned businesses. We've talked about architects before we actually started recording, which was an industry that seemed to take employee ownership on board, wasn't it?
Yeah. Right.
And a lot of them are quite small. So actually, some employee-owned businesses may only have 10, 15 employees. And if they had shareholders who, I don't know, they had 4 shareholders and 10 employees, you're already at 20%.
Yes.
So you've got to be quite careful in especially smaller workforces, I think.
Absolutely, yeah. And HMRC are aware of this and they'll look into that. But yeah, if you don't meet it, you can change it. Yeah. But then, yeah, as you said, you have to wait 12 months because it has to be this 12-month period before the transaction completes.
Yes, that is the one criteria that actually you have a look back on.
Yeah.
The others, the trading requirement, you just have to be trading on the day of sale. All employee benefit requirement, obviously there's no trust before you sell, so of course that doesn't look back. And the final one is the controlling interest requirement. So you have to sell at least, well, not at least, more than 50% of the shares into the trust so that the trust controls the company. And that is something I think perhaps before this new legislation was there was certain clients wanting to pay a bit hard and fast with whether or not they can actually continue basically doing exactly the same thing, controlling, running the company, but they just use an EOT to get some cash out tax-free kind of thing.
Yes.
And I personally think, and we'll come on to them, but the new requirements are going to help to, get rid of those tax planning type arrangements. And
yeah, they expressly they directly deal with that, don't they, in terms of the trustee independence requirement, which we'll speak about soon. That's definitely in there to stop basically the sellers loading the board of the trustee company or the number of trustees so that it favours them. So,
So we had those 4 requirements. We then had some disqualifying arrangements, which basically, in the main, just said if you fail any of those requirements at any point, then a tax charge is incurred. So the way the tax charge works is it's not an exemption. And I do feel like certain clients have struggled to get to grips with this. When you say you can sell tax-free, it's not, yes, it's tax-free to the vendors as long as those disqualifying arrangements aren't triggered and you've met the conditions, but it's a rollover relief effectively. So if you've got, I always use 10 million in any example I say, so apologies for sounding like this, but if you sell for £10 million and you incorporate the company for £100 20 years ago, the trust's base cost is £100. So if the trust ever sells, it's got a tax charge. And if you have a disqualifying arrangement, used to be you only had to trigger a disqualifying arrangement by the end of the following tax year of sale, that you would have the vendors suffering the tax again.
Yes.
And that's probably, and let's talk about that now as I'm talking about disqualifying. I think that's one of the biggest changes in the Finance Act 2025, the changes announced in the budget, that is going to make employee ownership transactions more about the business model, the genuine employee ownership, because now people have to wait 4 years following the end of the tax year.
Absolutely.
Before they're out of risk.
Yeah, we've had a number of clients who've explained this to them since that came into place in October. Not one of them has said, I don't want to do this, but they've all had an intake of breath. And like you said, if you complete today, 2nd of May, 2025, then the current tax year ends in 5th of April, 2026.
Yep.
You're then on the hook till the midnight on the 5th of April, 2030. So effectively almost 5 years.
Yeah.
And to say to someone, you sell today, you pay no tax, that's great. But if one of these events happens, and the two most likely, I guess, are a sale,
Yep.
so the EOT ceases to have the controlling interest, or it ceases to be a trading company, i.e. it goes bust, then you've got this 24% tax bill. That's, again, for me and myself, I think that's quite a long period of time when you have to lose control. And so you lose control of a company, you hand it over to the trust, so the trust buys it, but the trust and the board are in control. If they make some bad decisions in 3-4 years' time, which lead to the company going under, or if an offer comes in and they decide to accept it, you as the seller have a bill, a large tax bill. That is, that's changed from to 4 years after the tax year in which the deal completes. It's a big change. But interesting, we've already, since the 6th of April this year, we've already completed one EOT deal. So it's not stopping people. We've got another two which are due to sign on the 30th of April that should sign next week. So it's not putting people off. I guess the fact they still want to complete the deal because they're doing it for the right reasons. But like you said, clients have to be aware of that. But yeah, it's good for people who are saying, clients are saying to us, don't worry, we're sure the company's going to do well, and we still want to do this for the good of the employees. So yeah.
And that's kind of the point that, and again, it's probably, if you go back and read Graham's report and all of the work the people like the EOA have done to actually show what the benefits are. And it's not just the vendor's got to get a tax-free sale. Actually, the benefits are for the economy and, helping to improve the business, the workforce, the motivation, the retention of staff, all of those types of things. So the argument is actually by selling into an employee-owned business, by selling the business into an employee ownership, you're actually going to help the business to thrive, and therefore there should be less of a risk of things like that. You can never know, market conditions and things like that, can you? But the hope is actually this is positive for the business. The business isn't going to just carry on doing exactly what it's done for the last 10 years. It's going to actually thrive under this new business model.
Absolutely, yeah. And it's a case of why are you moving to employee ownership? And we often say, don't focus on the tax. In the same way we were saying, when you announce it to the staff, don't focus on the 3,600 bonus because actually,
not that valuable to
people it's not actually really about the 3,600 bonus for each member of staff. It's about more. It's about the culture. It's about changing the values and things like that, or retaining the values depending on what you've got. But yeah, we had suggested that because you sell to the trust and you must lose control and you cannot be in a majority on the board of the trustee company or on the number of trustees if it's just a trust without a corporate trustee, we actually suggested that there should be some sort of tapering relief, a bit like IHT, to say that after each year, maybe your tax bill goes down by 25%, so that if the company did go bust due to no fault of the sellers in 4 years' time or 3.5 years' time, whatever it may be, you'd say, well, you've 3 years have passed, so you only get it twice. So we thought that might be, but we've never really put it formally to the HMRC. We put it to EOA, but again, I don't think HMRC would be too interested in that. But it was just that sort of...
I think, I agree. The problem is you have this cliff edge. If the company goes bust 3 years, 364 days, you've got the tax charge. If the company goes busts 4 years and 1 day, then the vendors are off the hook, which is a bit of an unfair result, really. I'm wondering actually if you're that much close, if there's a way you just say we're just gonna get along for the next 2 days and just keep the business open, kind of thing.
Well, you could have a situation where actually sellers are turning around and saying, "Okay, you're in financial difficulty. I'll put money in." Yeah, because it's actually cost effective.
It's more cost effective. Yeah.
I'll lend you a certain amount of money to keep you trading
that's a very good
for
point,
another 3 months. So that I don't have, back to your 10 million example, that's a roughly £2.4 million tax bill.
Yeah.
A group of sellers might get together and say,
we'll put £500,000 quid in to keep you going. Yeah. At least to pay the employees' wages for a couple of months, kind of thing.
Absolutely, to keep the company trading. It depends how bad the situation is. So you have those sort of strange things. And you wonder if, I can understand why HMRC increased it, but you do just wonder if, is it going to put people off? I said, we're not seeing it so far, but people are they're thinking about that. That's the biggest change, like you said. Yeah. People are really thinking about that and going, because originally it's like 4 years fine. And then you say, but do you realise if it goes bust, in 3 years, 365 days, do you realise, or 4 days, whatever, do you realise this could happen? It does make you sit up and think.
You kind of think that, I mean, I know what you were saying about kind of what you were suggesting actually might be a better model. I think the biggest problem and the reason it's a good thing for the 4-year period for employee ownership generally is that you are basically saying those clients who are coming and saying we're probably going to sell in 3 to 4 years anyway, but let's get some cash out now and sell tax free, and then it becomes the trust problem. You're kind of getting rid of those people who were using it for a tax planning scheme, basically. So I see that as a good thing, but I agree with what you're saying. Actually, if you'd have tapered it down, but it still has that problem, doesn't it? Because they might say, well, as long as we sell 3 years, just after 3 years, we'll have got 75% of it tax free anyway. Yeah. And so, do you then get the legislation to distinguish what events might be acceptable to apply tapering to? And I think it becomes very complicated. Is the only problem. And the new requirements have already added some complexity. I do think, as just a general comment, the legislation isn't overly complex, which is a good thing. And possibly why more advisors are starting to take this on. Because when we started actually advising on this, I don't think there were that many advisors in the market doing what we were doing at the level we were doing it. Certainly sort of smaller accountants, a lot of them hadn't even heard of it because we were kind of going out and training them about it. So, but because, the trading requirement, everyone understands it already because of the other reliefs, controlling interest requirement. Yes, there's sometimes some really technical stuff in there because of if you've got some really quirky share rights and you've got ordinary share versus, what the voting rights are and nominal values and all the rest of it. But generally speaking, I think as a good thing, again, to help the employee ownership industry, the legislation has always not been as complex as it could be, or certainly other legislation is. So I think what I'm saying is the idea of adding more complexity is probably not ideal, really, is it? So I think we've covered all of the existing criteria, haven't we? So so let's move on to what we saw in the budget. And the main thing I think I wanted to talk about, other than maybe just explaining a little bit about the requirements, is how is this impacting current thinking for clients and actually the transaction itself? Has this impacted? Because I know certainly one that I had on going over the budget actually has been impacted by this. So the first one is the trustee residence, which before, and I never really understood why this wasn't already a requirement, but it basically said you can set up a trust for the benefit of all employees, and that trust can be offshore. Yeah. And of course, when you interact that with other CGT legislation, which says an offshore trust doesn't pay CGT on the disposal of shares, then all of a sudden you set up this offshore trust, the trust sells its shares whenever you like, or not quite whenever you like, but and you've rolled over your gain, and then the trust doesn't have to pay any tax either. Yes. Which was always a bit, why did they not include that? Like I remember Canada brought their EO legislation out, which wasn't met with much positivity from what I heard. But the first thing I spotted was they had that condition in about the residency point. Yeah. Really strange. We've never set one up like that, and I think you said you haven't either. No, just because it just doesn't quite feel right. Now we know some offshore trustees. We've spoken to some of the companies. They're very good, very reputable people. So I'm not saying anything like that, but it does just seem that you're getting a tax break. And if you're putting it offshore as well, why would you do that? So we've tended to just say it's better, even before the legislation, but the legislation is put to beyond doubt. And I think most people, if everyone I know who are involved in EO circles, they were all in favour of it. They said this is a good change. We don't want offshoring. I think there's very few that I actually know of that were set up, but I do know of a few. What is there to say about this? There is a disqualifying event for that as well. And the only reason that wouldn't be immediately triggered is on the death of a trustee. And that's the same on another disqualifying event as well. Yes. But basically it means that if you have a trust board that's actually made up of some resident and some non-resident trustees, if you fail that condition because someone dies, okay, you can fix it. You've got time to fix it. If you fail that condition for any other reason, someone walks off the trustee board and just doesn't want to have anything to do with you anymore, you've got an immediate disqualifying event. And that's another, when we come back to that 4-year period that we now have instead of 1, that's another risk for the vendors.
Yes.
And again, actually, the trusts that we've set up, I don't think have ever had any non-resident trustees anyway. So I wouldn't say there's a risk of that, but you do still have to be careful that, if you've got a trustee board, and actually, should we talk about trustee board? Normally we talk about having a vendor on the trustee board, at least whilst they're waiting for their consideration to be paid out. You normally have an employee to represent the employees, and then you normally have someone independent. So that has always been quite the standard model, I think, that's been advised.
Absolutely.
You can obviously do or you used to be able to do what you like. And so, we do need to be careful if some of them, or let's just say you've got three trustees and 2 of them decide to emigrate. You've got a problem.
Also, one thing is unintended. You could have a seller who obviously sells to the EOT, gets a lot of money and says, actually, I'm going to go around the world for a year, or I'm going to sort of spend more time in Spain in my villa there or something like that. And they accidentally become not resident in the UK. Yeah. So you could have that by saying, or an independent who starts spending more and more time off. Because again, normally the trustees meet every 6 months. Yes. So it could be you don't really realise, but your independents decide to go and live abroad.
I haven't spoken to you about it.
And why would they? I mean, why would they bring it up? Oh, I'm going to live in Spain for 6 months of the year, or whatever it is. So you have that sort of strange scenario. Could it happen? And obviously one of their requirements is now the fact that they've brought in the new requirement that the excluded participators, or mostly the sellers, as you said earlier, can't be 50% or more. It's not. Yes. It's not they must be more than 50%. It's the fact they must be less than 50%. Yeah. And as you said, with that typical kind of board of one seller, one independent, one employee, you've got the situation where again, death is the only
exception to that. Yep.
And you have 6 months in which to fix it. But we have the situation where, we just as lawyers, we're thinking, what if? Mostly it might be an employee resigns, but you would normally put in their contract, they can't resign unless they give so many weeks' notice. So you definitely want that in contracts for the employee trustee director, that they must give you at least 30 days, which at least gives you another time to, you might not go through the whole election process, but you could at least get another person on board, or the excluded participator, the seller, could temporarily come off the board.
True, yeah.
So that, so if you go from 3 and the employee says, I'm resigning and I'm leaving in 3 days' time, at least then the seller can go, actually, I'm standing down, so you've only got the independent left. But we've thought about it. There are some terms of the Companies Act which say you cease to be a director in certain limited events, and one of the obvious ones is bankruptcy. Yeah. So again, we're thinking of the scenario where you could have a situation where potentially the independent or the employee is bankrupted. Obviously, we hope that doesn't happen in the same way. We don't want anyone to die, but that death has this 6-month period to fix. If, unbeknown to you, your independent or employee trustee director is bankrupted, and they come in and say, really sorry, I was declared bankrupt yesterday, they've ceased to be a director, you've immediately breached it, you've immediately got your CGT bill. Again, is that right? Should you not at least have a month, 2 months to fix it? Because again, if your independent said, I'm really sorry, I've been declared bankrupt, you can say, okay, sorry to hear that. You could get an independent quite quickly, hopefully.
Yeah. I wonder, I don't know the bankruptcy process at all, but it doesn't happen overnight though, does it?
But would they tell you? Would your employer?
That's the thing. It's quite an embarrassing thing to have to then go and say, oh, I'm about to be made bankrupt. Yeah. But you do kind of think maybe there'd be some warning, or as a trustee, you'd feel the responsibility to at least give your fellow trustees some warning, even if you don't want to tell, the directors of the company, or you don't want to tell your other employee colleagues. Hopefully, I think the point with the death, it's something that literally could happen instantly, and there's nothing you can do about it. But most other scenarios, as long as you've got someone acting reasonably, and that's always a problem, isn't it? But as you said, really, it's a what if. It creates that what if in this.
And that's why I think almost, again, everyone I know in the EO world has said, we think this is a good thing. And everyone applauded that. It's just when you look at that, and it is hopefully quite an unlikely scenario, but if you did have that bankruptcy scenario, why should the sellers have to suddenly pay 24% tax? Why should they have this huge CET bill when, you know, an employee might not want to come and say, yeah, I'm struggling, or I'm in court tomorrow, I might be declared bankrupt because I've had some massive problem in my life. They might not want to come forward with that. And so again, you'd hope you know your employee trustee, but if it's an election, you might not choose that individual. It might be someone you don't want who's in there. So yeah, it's just that unlikely scenario. And is that actually what was intended by the legislation? Is that what it's trying to get at? But on the whole, we are extremely positive about this new rule, because we do, if it was one of the big criticisms of EOTs was that if it's set up by the sellers, the trustee board could be full of people who were...
You could just have the seller, couldn't you?
Yes, or two or three sellers and no one else. So that was a huge criticism of EOTs. And I think, again, most people I've spoken to have said,
I think everyone I've spoken to who advocates the model has said it's a good thing, at least.
Yes, agreed. Yeah, 100% agreed.
And that actually, the example I mentioned about that one of the EOT transactions that I was working on whilst the budget was ongoing, because we weren't pushing to get it done beforehand. Actually, we were looking for it more towards the end of 2024. But the intention all the way up to the budget was actually there were going to be 2 representatives of the employees and 2 vendors. So we had a 50-50. And as you said, the new trustee independence requirement is it has to be less than.
Yes.
I mean, it's an easy fix in those scenarios, because you just say, well, actually, it's probably a good thing you have someone independent anyway.
Absolutely. And we're hearing suggestions of 2 independents. So actually you'd have seller, 2 independents, and 1 employee. Although again, chatting to others, is that what you want? Because again, the people controlling the trust are 2 independents. Do they really know about the company? So is it better to have 2 employees then? So
possibly.
So we're thinking about it, and I think the way that, again, as lawyers, we're just looking at when we're drafting the documentation, in particular the articles of the trustee company, we're just saying to our clients, here's the risk, here's some ways we can try and mitigate it. But I actually don't think there's any completely bulletproof way of mitigating that. We just have to say, if you are very concerned about this, potentially put 2 independents in or 2 employees, make sure it's a 3 to 1 board, or a 5 to 2, or whoever your structure is. Make sure you try to protect yourself. Because again, the likelihood of 2 people being made bankrupt, you'd hope is quite slim. And so we don't see it as likely to be a problem, but we just have to make clients aware.
This is it. It's as we said, it's the what if. What else did I want to say as you were talking? There was something I thought, actually, this is quite important. It will come back to me. One thing I did feel like we've mentioned a few times about the trustee company and the trustee director. So we should just briefly mention how these things are typically set up, which is actually, yes, you sell the shares to a trust, which is for the benefit of all employees. It's just that trust is, the trustee is a company. And the trustees who would have otherwise been the individual trustees of the trust are directors of the trustee company. Yeah. And I think every trust EOT we've worked on has been involved a trustee company rather than individual trustees. Yeah,
when we first started doing quite a lot were just normal trusts as in they had individual trustees. Mm-hmm. But again, for various admin reasons, if trustees come and go, you have to have deed of assumption, deed of resignation, and of course the shares are in the name of the actual trustees, because the trust isn't a separate legal entity, and so therefore it gets a little bit messy. I think having a trust with individual trustees, one corporate, there's no reason why that should ever change or be struck off, unless it doesn't lodge its accounts or its confirmation statement every year, which is not that difficult to do. So from that point of view, we think trusts very much, they keep the shares, it's in the name, and directors can come and go quite simply and be appointed.
Much easier, And you mentioned that there is an article which I did for the ICAW that talks about a little bit about the accountancy aspects of these things, as is, they've got a help sheet as well, ICAW, of these things. So for those wanting to understand the accounting aspects, the headline is that this trustee company has almost nothing. In fact, it has nothing. It's a trustee of a trust. So the trust has shares. the trust has debt owed to the vendors if there is any deferred consideration.
Yes.
The trustee company is purely the vehicle for the individuals to be directors of, isn't it? So
Yes.
I always like to clarify that because I've had lots of questions about that. And again, as they become more mainstream, more accountants who don't get involved in this stuff and don't at all get involved in employee ownership, but they're the ones who have been the company's accountant for 20 years, and that you wouldn't expect them to know, but they need to now suddenly understand how you account for these types of things.
Yes, absolutely.
So it's worth covering that, I think. What else? The consideration requirement.
Yes.
I think that's a big one.
Lots and lots of discussion about all reasonable steps. What is that?
Yeah.
Obviously, a few weeks ago, we got the HMRC guidance, which is helpful to an extent. That's good to know. But yeah, lots of discussions about this.
I think this was probably the first thing that was raised as a potential issue when the finance bill was released and we had the draft legislation. It was what does all reasonable steps mean? Reasonable steps, fair enough. But
Yes.
all reasonable steps, how far do we take it?
We had one deal that was due to sign on the 31st of October, and it was just a case of sort of what does this? Wait a minute, we need to just sit back a minute. There's no guidance at that stage. There was no guidance. There wasn't until a few weeks ago. So what does this actually mean? And obviously, you've got in your mind what you think that means, but again, you're having to advise clients of just saying this was introduced. And that deal didn't actually sign, not because of that, but it was actually one of the factors that they had to actually say, right, how do you meet this? And there's been lots and lots of discussions with lots of different advisors, lawyers, tax advisors, accountants, EU advisors on what does all reasonable steps mean. And so the new guidance, very welcome. But yeah, and the main thing, you get a valuation. As you know, in most deals, the valuation is carried out before the trust even exists. It's carried out on behalf, it's commissioned normally by the company or by the sellers because they want to know what the value is before they're going to even contemplate an EOT. So the valuation is taken out normally a few months before completion. So that's one thing. It's normally in the name of the company. So again, we would say to the trustees, if you're acting for the trustees, you would say, well, there's a valuation, but you can't rely upon that. And the HMRC guidance does say that they consider all reasonable steps would be that the trust can rely upon it. So whoever done the valuation say, yeah, we did it for the company. It'll have that line, only the company can rely upon this valuation. And actually, normally it says it can't be sent to any third parties without the consent of the valuer, which normally they do give. But actually to say if they extend it, but if they refuse, and we've had that in some where the valuers have said we refuse to extend our duty of care to the trustees, what next? And I think the way we've seen it, gold-plated would be the trustees get their own valuation.
Yep.
There's obviously a cost impact to that. Second, we would say the trustees get another valuer firm of accountants to check the valuation and confirm that they think it stacks up and that it's right. I think that's a good thing to do. And third would be reliance. Another thing again is we've had other people say, but yeah, do the trustees really understand? Who is your independent? Who is your employee? Do they understand a valuation of a company? Again, I'm a lawyer. I've seen lots of valuations, but I don't profess to be an expert in. So again, we're also saying that maybe another thing to do is have a meeting or a call whereby the trustees can say, okay, then you have checked this valuation or you did this valuation and we can now rely upon it. Can you just talk us through it and why it's reasonable? And obviously it's not just a valuation, but also the interest rate as well. Yeah. Is it a market rate? But yeah, we discussed a few things before we came on today about the fact that, how do you value a company? In a lot of EOT deals, there's not an earn-out. So it's a case of companies valued at 10 million in this valuation report, but you're getting all without an earn-out, without retentions or things like that. Is that normal? Have you done the same level of due diligence? Does the share purchase agreement, do the legal documents have the same terms that you would normally expect on a third-party sale? So there's a lot of these questions which we just don't know the answers to. And again, I think we just have to explain to our clients and make an informed decision as to what all reasonable steps are. Again, I think it sounds like I'm criticising it. I'm not. I think it's a welcome move. You don't want people inflating the values.
It was easy to, or certainly it was more the people who were actually doing this as a tax ploy than actually the employee ownership element. But it was easy just to say, well, actually, there's no rule that says what you can't. you can sell at undervalue. There's a specific rule that says that. You can't technically sell at overvalue, but that's more because the trustees have a duty not to overpay, not because there's a tax rule. And there's also a question mark over actually if you sell at overvalue, then surely you've got an employment-related securities charge. So there were sort of separate aspects that could be a risk for selling too high, but actually now we have something specific that says you can't, otherwise you fail the conditions.
Yes, and it's also not just that, it's the fact that did the trustees take all reasonable steps? So even if they've got a valuation, it's a case of, is that all reasonable
steps?
What
level of due diligence do they need to do on the valuation, or how many I'm sure at one point someone said that, you should probably get 3 different valuations from different firms. And you kind of think, well, actually, that seems a bit extreme. As long as you're happy that you've used a reputable valuer, then, you shouldn't feel the need to then compare that to others, because, that's a costly exercise.
and as you know, to me, I always get this phrase, they say that evaluation is an art, not a science. And
absolutely.
And you could send, if you've got 3 valuations, it'll probably all be different, wouldn't they? They wouldn't be the same. And
absolutely.
I've had other clients who've obviously said, well, we went out to the market or we've had offers. So here are 2 offers we've received. But again, I think you do need to analyse that. A lot of offers come in at quite a high price before diligence, and then they look at it and look at, well, you're reliant on so many customers, or you're reliant on such employees. Once something happens to those, the market's changing exactly. There's lots of uncertainty over the last few years, haven't we? The various things, and right now there's so much with tariffs and things like that. So actually, you're sort of there thinking, how do you value a company? So what are all reasonable steps? It's really difficult, but clearly the old phrase is something's only worth what someone's going to pay for it, whether it be your car or your company. And if you have 2 offers on the table and you don't want to take those because you believe in employee ownership and you want to protect local jobs, etc., but is that actually the value? Maybe it is because the market's spoken. Maybe it's not. Maybe that's a high offer to try and get you. So it's not an exact science.
No, it's not. I mean, we have 2 or 3 EOTs that we've been involved with, which have actually been looking at a third-party sale initially. Either the deal's fallen over, so there is a deal that's gone quite far down the line, or actually they've had more conversations and thought employee ownership is the way to go, kind of thing. Yeah,
we had that once where, someone they were all lined up to sign, and then they found out of employee ownership, and the client said, "Wow, this is amazing! Why has no one?" Back to what you said at the start. Why has no one told me about this before? And they called the deal off. And they said, "I'm not selling. I'm selling to employees now. This is amazing." And so we've had some actually where they've been looking at the employee ownership route, and then someone else has come in and said, especially when they've announced it to the employees, the word's got out. Others have said, "Here's reasons why we think actually a sale to us is better for your employees."
Yeah.
And they've actually said, again, it could be changing markets, could be squeezing out of markets, or the need to be bigger to actually retain key customers who are expecting a larger organisation and all that brings with it. So we've actually had that situation where people, but twice actually, where a very compelling argument has been put to the sellers to say, don't sell to an EOT, sell to us. We will look after your staff.
Okay.
Yeah, really interesting. So like you said at the start, EOTs, I think they're brilliant, and I want to encourage them. And I've seen how they've changed people's lives. But also, you've got to look at the industry. You've got to look at, is it right for this business? And that's where it can change, because you could sell to an EOT, then a few years later there might be a sale later on for various reasons.
Yeah. Actually, whilst we're talking about industry, should we have a talk about I've been involved with quite a variety, should I say, of different industries. Actually, the ICAW do a tax podcast, and a recent one that they did was around an accountancy firm selling to an employee ownership trust. Yeah. And of course, accountancy firms regulated. So how does that impact with the regulator? And they talked about that. So I'm not really sure why I'm plugging. They're not a competitor. They're but they have a good podcast on that. So accountants listening might be interested in going and listening to that and that kind of experience. But it's the same in a lot of industries that are regulated. Actually, the fact that the company is now controlled by a trust needs to be taken into account for regulatory purposes.
Yeah, and we did one in Scotland. We sold to an EOT for a firm of accountants in Scotland. I went to speak to ICAS in Scotland, the same body. It was like the Scottish regulatory body. Yeah. They were very supportive because, like law and various other industries, professions, as things are changing, then employership is potentially a good succession option to keep all the staff. So there's some bits and bobs you have to get right with your regulator, but it could be a very good option for accountants.
So lawyers, we've been involved with a few there.
Yes.
It sounds like 2 or 3 accountants, but very early days for the accountancy industry. But again, if we're the ones advising on it, why aren't we actually taking it? So there's that element. Architects, I think that's been the case for years now in the architecture industry. But all kinds. So retail, manufacturing. Those are the types of other industries that seem just as suited. John Lewis is the obvious one.
We've seen travel agencies, joinery firm. We've done asset managers, so IFAs. We've had to go out or help our clients go out to ICS, FCA, care regulator, gambling commission, things like that. So we've spoken to them. There's Carlton Bingo in Inverness. We did their EOT. So it can be all sorts of areas, and it really can suit. It really can suit every business depending on the circumstances.
I've not yet come against a regulator that isn't either supportive or at least allows it to happen, kind of thing. So it'd be interesting to know if there is any industry that is kind of a definite no, but I can't think of one that couldn't sell into an EOT if it wanted.
No, another thing, of course, that we mentioned is EOTs. Again, they're not exempt from some of the other regulatory requirements, in particular NSIA, which is national security and investments. So sometimes if they are in one of the 17 sectors, then yes, you need to get NSIA, and we've got one deal where they've now got the NSIA approval, so that's now moving forward. Okay. Again, we mentioned FCA, and again, competitions and mergers. Again, it can be the fact that is that a change of control? Mm-hmm. So you're not exempt from all the other requirements on a standard sale.
So we've covered trustee residence, trustee independence, the consideration requirements. So they're the big new ones. The distributions relief, certainly from a tax advisor's perspective, that's a change that does impact the work we do, because we used to say almost a bit of a fudge of how do you fund the trust to pay the vendors out. You would say, well, we're going to contribute rather than distribute the funds from the trading company up to the trust. And the reason we had to say that is because, well, if it was a dividend, then the trust, which is a discretionary trust, is subject to additional rate tax or trust rate tax. And therefore, obviously, it's going to be hugely tax inefficient, and it can't possibly, or probably 90% of EOTs wouldn't have gone ahead because of it being impossible to fund. HMRC used to provide a non-statutory clearance, and we'd always get one on every transaction that just said, yes, we'll agree that anything used to fund the buy or the trust acquiring shares can be covered by this clearance, which basically says we're not going to treat it as a dividend to the trust. Which made sense. It was a bit frustrating that it seemed like this was not clearly thought about when the legislation was first announced in 2014. But it also kept things quite simple, because other than having to write to HMRC with a pretty standard clearance application, that was that. Now we have a relief. So now we have a trust which is receiving dividends, because HMRC are now saying, no, it's definitely a dividend. They're receiving it in a capacity as shareholder. And that's more of a corporate law thing, so you could probably explain that a bit better. But it is a dividend, it's not a contribution, and therefore they have to give some form of a relief. Otherwise, again, the model breaks down, doesn't it? The downsides of the relief, have you had much in the way of the sort of more recent deals you've been working on? Because, of course, the relief is very strict in terms of what you can claim relief for.
Yes, so when it was first announced, everyone was delighted, like you said. And then you looked at it and thought, I'm not sure if I'll get this right. It originally only covered the initial consideration and I can't remember what else it was.
Deferred interest.
But it didn't include, I think, was stamp duty included?
I don't think stamp was included.
So that's one of the things, stamp duty.
Yeah.
And then people
professional
are saying,
costs of
that was
the independent trustee. How do you pay
that was the big one, was costs. I'm actually going, wait a minute, if the EOT's got costs, legal fees, accountancy fees, whatever it may be, then to pay those, you're going to go to net amount.
Yeah.
So you have to get a huge dividend. But they did change it. So when they actually introduced it, so that was great. Again,
that was a really positive change.
That they listened to it, and they did put in, and I can't remember the exact wording, but is it reasonable costs?
Reasonable.
So I think the view is that that now would cover an independent trustee's costs, probably, I think. But what I don't think it covers is any subsequent acquisition. So if the EOT acquires 80% and there's 20% outstanding, it's still held by the sellers or by managers or whoever it is, or the EMI options are exercised and the EOT is diluted from 100 down to, say, 90%, then if those shares are bought in, that's not covered by the new relief, in my understanding.
I agree,
and therefore, that will have to be netted. So if you did that, so again, we have to say to people, because sometimes we're actually find quite a lot recently where people say the company's worth so much that if they sell to an EOT and it's a full 100%, then it'll take about 12, 15 years for it to be paid. So actually one way that some sellers are saying is, well, if I only sell 80% or 70% to the EOT and retain some, that's quite good because then the payment period shoots down to 8 years. And that's more palatable when I announce it to the staff, which is understandable. So staff could say, all right, in 8 years' time, that's as opposed to 15. But then, of course, we're saying to them, well, if that happens, obviously you won't get the CGT relief on that on your stake that you keep. But also, if the EOT, which is the obvious buyer, is wanting to buy your 20, 30% stake, it's going to have to pay tax on that.
I mean, if you're paying tax on, say, another 5 million quid, you're actually going to have to pay a dividend of about 8 million. So, the funding period is far extended because normally the EOT is just funding it out of future profits.
Yes.
I mean, again, shall we talk briefly about bank funding? I don't think we need to go into it too much. I think there are more banks starting to accept an EOT and understand an EOT business model, and more banks that I used to say there's two that I know of that are actually willing to lend to this model, whereas I know, and I'm not going to name them, but I know some even more high street banks starting to sort of get in on employee ownership business models. So
we've acted for 3 banks funding EOT deals. We've got another deal in the go right now where we just completed one where another bank came in. So the mainstream banks are lending. They are seeing it, and like I said earlier at the very start, they're seeing their clients inquire about it. So that's a brilliant thing, and I think that makes a massive difference.
I think that'll make a big difference on encouraging improving the growth in the industry.
Yes.
And
the one thing you have to be careful about, of course, is a lot of these companies are family or owner-managed businesses. They've got very low debt or no debt, and then you're introducing a large debt into the company. But again, it's all down to affordability. And in any EOT deal, we always say that a key factor is affordability and being realistic. Because we've seen that before where the projections or the payment schedule for the deferred consideration has been quite challenging. And then if these targets don't get met, everything is off on a bad footing. The management team feel under pressure. It's just not good. Better to be conservative, I think, in your payment schedule.
Absolutely.
So that it's realistic. That's just good because that's, I think, more in line with the ethos of employee ownership. But to now introduce debt in, again, if it's affordable, just like the deferred consideration, then it's fine. But again, the sellers they get a little bit more now, but that's likely to mean that they will clearly rank after the bank, and therefore the bank gets paid off before they get paid off. But it certainly can be. But I think it's a key which has unlocked a lot of doors to EOTs getting that bank funding in, because it just can tilt some, especially with like 4 or 5 shareholders. Some will be massively in favour, some will be more sceptical. If you can get some bank funding, it just means they get more out on day one. And that's great because the deal gets done, the EOT owns it, the employees are now incentivised, and it's good for the banks as well. So
And I've actually got one ongoing at the moment who they've never had bank funding in the business for decades and don't want any bank funding, and therefore are selling 70-something%. Because again, for the same reason, affordability for the company. If you put the business under that much risk again, and we we'll probably spend a few minutes talking about selling out of an EOT as well. But the whole point of the legislation, and as we'll see when we talk about selling out, is that this whole thing is designed for long-term ownership. The 4-year thing, the disqualifying event rule, I'd call that medium term. But actually, long-term employee ownership is what is really intended here for the point of, again, it's for the economy and help the growth and all the rest of it. So why would we want to incentivize people to sell out after 5 years kind of thing? And so, when it comes to the affordability and paying off that deferred consideration, whether or not there's bank funding or not, you don't normally see immediate impacts to the employee, other than, yes, how we sell it, will we motivate them and all the rest of it. Actually, the first few years are normally, we still have to make the same profits or more that we were making, and we're paying off the deferred consideration. It doesn't mean there's more in the pot for the employees to suddenly get massive bonuses and stuff. So that is obviously quite crucial. And sometimes actually I've seen vendors say, okay, well, the company's making, let's say, £1 million a year. We want 800,000 a year, so that there is something in the pot for the employees immediately, which works well because it kind of says you don't have to wait 5 years to start to see some financial benefit out of this.
We've seen a lot of cases where, in order to let the employees know this is real, and it's not just the sellers are doing it for tax reasons, quite a lot have actually declared a tax-free dividend bonus in the first year. Some have actually completed, and then a few months later, so they've completed in October, and at Christmas time have given all staff a straight £400 or £500 tax-free at Christmas to say this is real. It's not just about us getting our money out. We are embracing employee ownership for all the right reasons. I think that's very powerful. And so, like you say, and a lot of people have said that, we made £1 million roughly a year profit for the last 5 years. The payments are 800 grand. That gives a bit of wriggle room, and it also allows a bonus to be paid, so the staff do feel it and start to really believe that this is it's real. It's
and actually, now we've just been talking about that. If you remember a while ago, I thought there's something I wanted to say, and it was when we were talking about the makeup of the trustee board and independent trustees. And I was going to say, okay, well, who are those independents? Yes, you can have someone like an accountant, which someone with a financial mind might be helpful. Yes. But there's actually independent trustees out there. Well, Campbell McDonald, who's on the last EO podcast that we did, is undertakes some of those roles. But people like that who can help to get the most out of employee ownership, I think there's real value in those types of people. Who actually understand this model. How do we sell this to the team? How do we, really get the benefits of employee ownership in the initial period? How do we announce it? How do we keep it going? How do we keep that mode? Because if you announce it and just say, all of a sudden you guys are all going to get massive financial benefits, you're going to, you can come in at 10, leave at 3, all of this stuff. That's going to, the motivation is going to be like up here for about a month. And then everyone's just going to leave. And that's not what you told me. People who can understand how to sell this and explain this to employees in the way that is realistic, as well as gets the best out of them, I think there's some real value to those.
Absolutely, yeah. Like every business, an employee ownership business goes on a journey.
Yeah.
And to begin with, I think you're a really good point there that we normally say the first independent should be someone who's got EOT experience, so they can help you through that. Hopefully it's all good, but like anything in life, there are ups and downs, there's misunderstandings, miscommunications. So in that point of view, having an independent who knows about employee ownership, I think is really, really valuable. But there might come to a stage where they've done that, everything's bedded in, it's going really well. You want someone who's got a bit more industry experience or a bit more financial, depending on the phase. And the other thing I'd talk about the stages is, again, a lot of people say there's 2 EODs. There's the day you sell to the EOT, and financial freedom day, which I don't really like that phrase, but I think it's but it is what it is, isn't it? It's the day when the sellers are paid off in full, and that's when things do change. And that's why we would always say that, and we're starting to see this because a lot of the EOT deals we did in 2016, 2017, 2018 are starting to be paid out in full. And actually, back to your example of companies making £1 million a year, paying 800 grand a year out to the sellers, when that stops, that company's suddenly got £1 million. what are you giving that to all your employees, or is that actually the best interest? Or do you reinvest? Do you have EMI options and then keep some of that money as a pool to buy back when the EMI option holders want to sell their shares? Or if it's a 70-30 EOT deal, okay, I've paid these guys out, but we'll keep some of that £1 million each year in a pot to maybe buy that remaining 30%. So there's lots of things you need to consider. But yeah, I do think that Financial Freedom Day, I can't get you've got to call it that because everyone does. But yeah, loads of employees have told me that's when it felt real to them, actually. Because again, whether it be skeptical or just being realistic, some employees have gone, oh yeah, but for the next few years, I'm only working to pay the sellers. You're like, well, maybe, but think about it.
It's the same as an MBO. If you think about, when you just sell to the management team, they normally do the same thing. They work 3 to 5 years to actually pay off the originals, and now all of a sudden you've got a company that's worth X million pounds and it's yours.
Absolutely. And that's what we say to the employees. Once you've paid these guys off, you will own this company.
Yeah.
And if it is sold or it makes £1 million profits, you will really start to see the financial benefits of that. So yeah, that is something.
We are running short of time, actually, and I knew we were going to struggle to get into selling out. But before we get there, I just want to talk briefly about, so we've talked about incentivizing individual management in terms of EMI options, which I think is the obvious route in most cases, assuming you qualify. One question I had recently was, okay, but how do we get these shares back from the employee? As in, we're incentivizing them by saying you can have options, and then, if we want to buy them back in a sort of as soon as they exercise, how do we do that? So if they exercise and have an EMI option, the company buying the shares back is not going to be that tax efficient, because to have a company buy back shares and for it to be subject to capital gains tax, it has to be held for 5 years. And an EMI option, unless they are going to do that, if my specific question, or the specific question asked of me, was that they're going to sort of sell it back to the company straight away, and the answer is it's subject to income tax then. Can you do a sort of an MBO structure where you put a new holding company on top and buy it all out and do a share exchange for the EOT? That has its own intricacies with the EOT legislation, and is that technically a disqualifying event, and will that work? So again, not ideal. Can the and this is kind of one of the points on the distributions relief, can the EOT itself buy the shares? Well, no, because the distributions relief, so when you pay a dividend up to give it the cash to buy the shares, that distributions relief isn't available because it's not on the original share acquisition.
Yes.
So actually, just like employee ownership generally is a long-term model, I think the EMI option scheme is just as much a long-term model. I mean, they might just say, well, actually, I'm paying income tax, but it's money I wouldn't have otherwise had anyway, so I'll just suffer the tax. But I don't think there's a surefire way to, get capital treatment for that EMI option holder.
Absolutely, yeah. There's a lot of discussions going on before the EMI, because one of the obviously things you would say is, well, make them exit-only options. But again, does that fit in with the EOT ethos that the whole model is meant not for there to be really an exit? Obviously, there can be, but it's a case of, is it send mixed messages? We sold to an EOT, then we gave the managers exit-only options, so you can only exercise them if there's an actual sale. So that doesn't seem quite right. But then you're saying, then they can exercise them in a certain condition. In almost all that we've done, one of the conditions before exercise is that the original sellers are paid off in full. So actually, so you have to do that. So again, you're saying to them, it might be 6 or 7 years before you can exercise this. But again, that's incentivizing them to pay the sellers, which is certainly good for the sellers. And then, but yes, they then get the shares. If they leave, they can hold them for as long as they want, hopefully get some dividends. But if they leave, yes, how do you do that? And before it was quite simple. You would just say, that's fine. The company will gift the funds to the EOT and the EOT will buy back your shares. But now, yes, as you're saying, it
doesn't cover the relief.
Yeah, it doesn't cover by the relief. So that's a bit of a,
I think the key thing is, and most of the time you're trying to incentivize, especially your senior managers, to stay at the very least to pay off that deferred consideration. Hence why you apply a condition to to be able to exercise the options. But then the idea is not that key manager is all of a sudden going to leave anyway.
Yes.
So the EMI option does still have value. It's also worth the client understanding. Actually, this isn't something just to get the key manager some cash at the end. As soon as you've been bought out, it's not a sort of a bonus mechanism for your key managers.
As I said, in all the EMIs we put in place for EOTs, they've said, because when it comes to actually, if the manager exercises the EMI options and whether they're leaving or whether they're staying, they just want to cash in a bit. Again, what's the market value of that?
Yeah.
Because if the EOT owns 90% and they own 10 or few of them own 4.99%, then what is 4.99% worth or 5% worth? Is it actually worth that? And if you're the EOT trustees and I own 95%, why do I want to buy in that other 5%? But so the trustees have to look at their duties. I guess one would be, we want to incentivize the managers. And so if we're given these options and they can't ever sell them, that's not really serving the purpose. We'll struggle to get good talent in when these people do move on. So I can understand that there is a reason and a rationale whereby you can justify the EOT buying the shares. But and all have said, whilst it's not going to be written in stone, they are going to put a little bit away every year into the company's bank account, which will be ring-fenced for buying in those shares. But like you said, after October, you're going to have to pay a lot more. And that's not really what we were hoping for. But there's still a mechanism for buying the EMI shares if needed.
Let's just quickly talk about selling out. I know we've both worked on deals where there has been an EOT which has accepted an offer to sell its shares. I think that comes with very, very quickly the main highlight, and what's always worth explaining to clients as well, is when an EOT sells the shares, obviously its employees are the company's employees are the beneficiaries. But there was a case, Brumley and Milner, which basically says the payment to the employees is income tax. It's earnings, therefore PAYE and national insurance. So that it's not just actually that it's income tax and that they some get a dividend or something. You've got national insurance on that as well. Some of the issues that we came across were who's going to operate that, because again, the EOT very rarely has a bank account. It seems the EOT certainly doesn't have a payroll. And actually, when we were doing the transaction, we had an opinion from an employment tax person who basically said, yes, it can be the company itself that operates the payroll on behalf of the trust.
Yes.
So I think that's pretty much standard now from what I've heard. But the issue being, obviously, it's very tax inefficient. And so if we look at the fact that the EOT has very little base cost, it's got to consider the fact that its employees are now paying a very high amount of income tax on that, 40 or 45% if it's a decent chunk of money as well. And so, we come back to the question for the trustees, is this actually in the best interest?
Yeah. And when you're on there talking about the deductions from the price they get, is anything due to the sellers?
Yeah, I haven't even covered that.
Because there's deferred consideration paid. And you talked obviously about the disqualifying period. If the sale on by the EOT is a disqualifying event, that can lead to the original sellers.
Yeah, if it's within the 4-year period.
Has there been an indemnity? Are they a minority shareholder, in which case they might refuse to sell? Are they drag and tag? So there's lots to think about. And in particular, the main thing I look at is who's deciding. Obviously, it's the trustees who are selling. What does trustees say? Do you need consent from the employees? Mm-hmm. I've not done I've only done a few sales, but every single one they've gone to the employees, whether they need their consent or not.
Right.
It's employee ownership, I guess, is a clue in the name, isn't there? Mm. And so they go out there and get the employees' consent. But there's a timing issue, a confidentiality issue. When do you go and tell the employees? At the start of the process, before you have all the costs and all the time spent on it, but then that gets word out. Will the employees?
Yeah, I mean, if you've got a big workforce, the employees aren't in the best will in the world. You've got 200 employees. Someone's probably going to say it, to the mate down the pub or to the wife, who then goes and tells everybody in the family, and it's no longer a confidential deal, kind of thing.
Absolutely, and if you leave it too late, then you've spent a lot of time and money getting to this stage, and then the employees turn around and say, "No." Again, is the buyer going to want to spend all that time and money on his diligence and on negotiating the legals, and then at the last minute the employees don't vote in favour of it? But also, does he want it out in the marketplace? Again, what happens if you tell your employees early, then it doesn't actually complete due to there's something comes out in diligence?
Yeah, there's plenty of deals that do fall over,
Then, thankfully they are few and far between, but they do happen, like you said. So again, does that unsettle your workforce? So timing is vital. Do you need to get their approval? Again, we mentioned before, do you need the NSIA approval? Do you need have the sellers got a veto until they're paid in full over the sale? Do you need to go and get their approval as well? So there's definitely lots and lots to think about on it all. It really does. There's a lot to consider before going through the sale. And as you said, it's not what EOTs were designed for. It can, in a sense, not be cost effective, but we've seen it go through because there can be other reasons. I think the other thing you've got to ask yourself is, why are you selling the EOT? Why is the EOT selling? Is it because they think it's in the best interest of the employees because they'll get money? That's possibly perfectly valid, but is it for other reasons? Is the company distressed?
Yep.
Is that having a problem getting capital? Does it need to grow? So are you saying it's in the best interest of our employees to sell so that money will come in and we'll be part of a bigger entity? Can it be a competitor who will squeeze you out the market? They'll start to steal your staff or they'll start to undercut you in the market. So there's lots of factors.
Yeah.
They've also got to ask, why is the buyer buying it? Because they know they're buying an EOT and it's successful. What we're seeing is that there's quite a lot of interest in buying from an EOT, and that's because people are seeing them doing well. But of course, it's doing well because it's employee-owned. And you're immediately saying to staff, well, the 3,600 bonus will be lost because you're selling. So how do you actually do this? So why is the buyer doing it? Is he going to keep the values and the culture going? As you said before, a lot of the reasons why people sell to EOTs is because they want to protect their staff. They want to keep it in the local area. And if you're going to sell to a third party, are they going to do that? Because as you've seen not that often, but again, quite a lot, some people say, yeah, we're going to keep everything the same for the next 10 years. And then after a year, they change it all. So there's all of these questions you have to ask in there. And when it comes to the who question, the other thing is, a big point is, who's standing behind the transaction? Because the trust, as you said, is going to get the money. It's going to immediately distribute it. So if you're acting for the buyer, you're saying, well, wait a minute, where's all the warranty indemnity? And so I think the solution that most people are going for is W9 insurance.
Yeah.
So especially if it's 100% owned by an EOT, the independent is going to get no money. So he's not going to back of the war. The employee, okay, he's going to get some, but he's not going to put his neck on the line for everything that 200 employees are getting. And the vendor, he's an excluded participator, so he's not going to get any money. So the trustees are not going to stand behind it. So yeah, I think W9 insurance we find is quite a good solution, but it's another factor that has to be considered.
Into the cost and it dwindles down, and is it again in the best interest? So,
and the other thing, some buyers are coming in and saying, well, you have deferred consideration and things like that. But again, as an trustee, as an employee, how attractive is that? Even for the buyer, if you say deferred consideration and you say to all your employees, oh yeah, by the way, at the end of year one, you're not all getting this additional payment because you didn't perform well enough. You've then got 200 pretty unmotivated staff. So yeah, you have to think of structuring it.
But there's also, sorry to interrupt, there's also the point that if you suddenly give all your workforce you've had a really valuable company, so you give them 50, 100 grand as a bonus, are they going to go, actually, that's enough for me, I'm going to retire early or something? So actually that's going to be an issue for the buyer that they're going to be carefully considering. So there's a lot to think about.
A lot to consider. As I said, we've seen a few, we're seeing a lot of interest just now in them, but yeah, you really do need to think about it as to, is it going to work for both parties? But yeah, we've certainly seen some employees get life-changing sums of money. And again, a lot of people do criticize it on the basis that, well, what they get is subject to income tax. They're probably going to pay 40 or more %. But the way I look at it is, if this company wasn't sold to an EOT, then 3 or 4 shareholders would have got all that money and the employees would have got zero.
Nothing. Yeah.
So the fact that someone is getting 20, 50, 60,000 pounds, where 3 or 4 years ago they would have got zero, that's incredible. That 200 people are getting 50 grand. That's a lot of money put into the economy, isn't it?
It is. But I think the key message is that this has to be when you're selling into an EOT, thinking, let's think about how we're going to sell it in 5 years' time out of it, is completely the wrong way to think about an EOT. It has to be long term, because not just the fact that it's not cheap to sell into an EOT, and it's definitely not cheap to sell out of one either. So we've got all of these things to think about, and obviously it can be extremely good for the economy for all the reasons we've said, but all of the negative tax implications, and I think that's by design. I don't think they put this together and said, this is employee ownership. Of course, it's going to be a capital distribution to the employees at the end of this. This is a long-term benefit to the economy, so they want you to stay in employee ownership. So of course they're going to make it more difficult to sell out.
Yes.
And I think that's the message on anybody who's thinking employee ownership as anything other than a long-term plan is going to be need some careful consideration.
Yes.
I think that's all we've got time for.
Yeah, that's great.
I keep talking. We could carry on. We've talked.
Yeah.
I mean, just together before this, and the last time we met, we spent much longer talking about selling out of an EOT. So
absolutely,
it's a big topic and something worth think. You've got to think about it when you at the very least. But it's an interesting one, and it's brought some really interesting debates, I think, among people who have been involved in it so far. So
absolutely, yeah. And we just see the great stuff. I think I always enjoy about when you're doing EOT deals, speaking to the client a year or 2 years later, and just hearing some of the stories of how they've seen the them and us change into us and us. Yeah. And when people really embrace employee ownership, you really see that difference, and employee-owned businesses really can make a difference. That's why, myself and my colleagues who work on EOT deals at TLT, we're really passionate about EOTs because we can still make a difference. We've seen some staff announcements, staff in tears, owners in tears that their jobs are safe because it's not being sold to someone who's going to shut the plant or move it away somewhere else. So we really have seen it. So for all those reasons, we do think EOTs are great.
It's a great industry to actually be involved with as an advisor, isn't it, as well? So it's nice.
Really enjoyable.
Yeah, excellent. Well, thank you very much for joining me, coming all by. You didn't quite come all the way from Scotland, did you? Because you've been at the EOA conference yesterday as well. But thank you very much for joining me. Thank you everyone for listening, and hopefully we'll catch you on the next one. Yeah.
And thank you for inviting me. I watch these podcasts on your Technical Tuesdays, and they're great. So
thank you.
Great to actually be here and be in one. So
cheers.
Thanks.